Your products have typically included some hedging, and in terms of your product development, do you anticipate this continuing in the future?
Certainly. We're hedging risks every day. Again, it's another cornerstone of active management. We're looking for risks that you're not compensated for, that you're trying to hedge away, and at the same time looking for opportunities to capitalize. So that's ongoing. We talked a little bit about the opportunity to hedge some of the interest rate risk that investors face through the use of an income-oriented portfolio. But I think there's a few other, at least a few other risks in defined contribution that really aren't being hedged all that effectively. One of which is inflation. It's no secret that inflation's low around the world. It has been for a while. The collapse in oil prices certainly hasn't deviated from that theme. And we've seen inflation expectations as measured by the market declining pretty consistently up until just a few weeks ago, where it's reversed course. But all of that, I think, has led to a lack of motivation by plan sponsors to add real assets to the plan, which is a really important diversifier to have. Real assets tend to do well when inflation's going up, naturally a hedge, and that's the same time that traditional stocks and bonds are struggling. So it's an important allocation, and where we see plan sponsors with that allocation, it tends to be pretty small, and it tends to be in a single asset class like U.S. TIPS, which is fine, but they're, again, thinking about optimal allocations, we would recommend people think about a multi-asset real solution. Things that, a solution that includes a broader set of asset classes like TIPS, commodities, REITs, currencies even, gold. There's a number of assets you could include. But the benefit, of course, is that you've got a portfolio that's hedging inflation risk in a multitude of environments, not just the environment that TIPS do well. I would say the other major risk that's, and I'm sure there's others, but I'm just keying in on two, that is unhedged relates to currency in non-U.S. equity portfolios. It's pretty commonplace in defined contribution plans to hedge the currency risk out of non-U.S. bonds. Most plans that have a global or a foreign bond option, they've hedged back to their local currency, dollars in this case. But you find that there's very little hedging going on in non-U.S. equity space. And I would argue that that's not a risk that plan participants that they know they have, first of all, or that they're seeking, and I don't think it's a risk that they're being compensated for.
Certainly a very dynamic environment, and we certainly appreciate you coming on the show today, Rick, and sharing your ideas and insights with staying ahead of the curve.
Thanks for having me. Happy to come back anytime.